doing business in Africa. You can't afford to be without Africa Investor.
Ayman, if I can call on you, please, to address your recommendation number 5. And then I'll work behind the scenes with Dr. Wagacha. And your recommendation, the one that you raised, which is to motivate governments to consider directing some of their quantitative easing and emergency funding towards sovereign wealth funds to allocate and invest in their local markets. The floor is yours.
Thank you. Well, that was inspired during our last conversation, and actually with the example of the Nigerian experience, where they directed some of their funding towards to be spent through the sovereign fund. The premise of this idea is governments. The initial reactions of governments are debt relief. For instance, in our market, the first action taken by the government was a 300 basis point cut in the reference lending rate of the central bank. So they've pushed aggressively towards reducing the cost of borrowing, specific payment rescheduling directed towards SMEs, directed towards the sectors that are mostly affected, like the tourism sector, most of the services sectors. Once these sectors receive that relief, yes, that cascades to a short-term solution, but it doesn't really unlock the issue. Those businesses are going to be piling up more debt at a lower rate, but they are still piling up more debt. So the direction goes towards equity. And this is where the thinking of directing a portion of your emergency funding towards the sectors that you know are one priority to your local economy. The nationalistic pressures rise when you want to have your food security, when you want to have your medical security. These come at the forefront of your priorities, and they come to mind where with closed borders and with lockdowns, what do we have to work with? So directing some of those investments towards either distressed businesses, and that should be a temporary measure. So this is a quasi-equity participation or an equity participation that goes through public market instruments, where you are able to retract that back or monetize that as the market stabilizes, and you carry your gain as a fund through that a position that you've taken. And back to what Hubert mentioned earlier, we're banking on the pedigree of the professional teams that are there in the sovereign funds that are able to conduct a buy-side investment, craft an investment agreement that does not portray maybe a nationalization. This is not a nationalization drive. This is not a lot of rhetoric has been around how China managed to use this to its advantage, and they're buying back a lot of private sector ownerships to the government. We should not be doing that. If any, I would imagine that these QE spends should go into minority positions, creating fresh partnerships, public-private partnerships, with a view of banking on private sector management and talent and capabilities, while enabling them and scaling them up to deliver and fulfill priorities that are national priorities to the local economy now. And you can extend that to regional economies. And in my view, neighboring countries can extend that mandate through their own funds. And this collaborative use of capital. Africa is by design stripped for capital, so you can maximize your firepower. Back to Soliman's point on you have your slew of infrastructure projects. When you look for partnerships, you maximize the firepower of what you can do with your capital to deploy to the maximum number of projects through partnerships. And that rests on creating the right product that is attractive and aligned with investors across the board. Infrastructure projects, which are a focal point of this forum, remain to be an active asset class that has not been as adversely affected by the COVID and the lockdown. Appetites remain to be solid in that respect. Investors, be it from the Western market or the West or the East, as we said in Africa, we see Asian money coming in, we see Gulf money coming in, and we see Western money and European money coming in that are looking at the infrastructure play, particularly in Africa, and which is a very solid support in my view. If we are able to convince our governments to share the same priorities that we have, now that you read and you have the sense of the appetite and sentiment of the investor world, it is your responsibility to go back and relay that back to the government, educate your government officials about what your reading is of the world, and based on that, this is a de-risked investment of those emergency funds going in the right products or going in the right asset classes that are least affected or that are going to be in demand. For instance, if you're manufacturing testing kits for the viral test kits, if you invest, and these are actual examples of transactions that are there presented to the government to say those entrepreneurs and those private sector investors come to the funds, come to the sovereign fund with ideas, and they'd like to have that partnership with that particular fund as a partner vis-a-vis going to a ministry or going to a public health institution in that particular country. So I think this is where we can entice governments and de-risk that proposition by making a recommendation that says direct part of your QE towards industrial assets in the areas that you know for sure are least affected, and the appetite is there. So you relay that appetite based on your own reading of the markets, and it needs to be structured in a way that does not look, feel, or even translate to a nationalization of those private assets. It should not be the case.
Doing business in Africa, you can't afford to be without Africa Investor.